Hello everyone. So we now know what is an initial issue and the method of flotation of issues, and I've explained you pretty much what is a public issue, rights issue and everything. So we're going to see that in detail what it individually means. Public issue or going public. It is a phrase used in the corporate sector. They will say that the company is going public. The company is, the firm is going public or whatever. Recently, IRCTC company has gone public or it went public. So this phrase is used to mention the fact that the company, whatever the private or limited company it is taking the decision to acquire investment from the general public. So the starting point of any company is that the promoters will invest some money, even if whether it is a big company or small company, it doesn't matter. There will be some kind of promoters, and the promoter does not even have to be an individual person. Two or three companies combined together and could become a promoter also. One company could separately invest in a business and be the promoter of it also. So the promoter can be a person or another company or even a government. Therefore, a promoter invests money in a company and he incorporates the company. After incorporation, the company will considerably acquire revenue and all other stuff. After doing so, to increase the size or the net worth of the business, the promoter will acquire funds from different people. So for a private company, the number of investors who spend money to invest in the business could be maximum of 200. So you can ask for 200 people to invest in your company. You can ask for 1 lakh rupees each for the 200 people, and you'll acquire 2 crores to invest in your company. And after that money, even if they are willing to invest more, they can, but 1 lakh is a huge amount to give. But for big companies like Reliance, Tata, Mahindra, IRCTC, ITC, TCS, Wipro, so on and so forth. 2 crores is actually nothing. They are thousands of dollars of worth of businesses. Therefore, if they need to start any new project, if they need any new investment, it will be in hundreds of thousands of crores. So to acquire that kind of investment, you cannot ask for only 200 people. You need to ask for about the whole public to invest such kind of money. That's why the big companies always go for public to acquire such kind of investment. That's what going public means. So they go and ask public to invest in their company. So public is a huge population. So the amount of people who have invested in share market could be, I don't know, 10 or 20 lakhs or 50 lakhs, probably even 1 crore people. So even if 1 crore people each invest 10,000 rupees, just 10,000 rupees, it will be 10,000 crores. So therefore, that's the difference that it makes. So even if they each only 1,000 rupees, 1 crore people, if they invest 1,000 rupees each, it's 1,000 crores. So 1,000 crores is a considerable amount for even for big companies. Therefore, going public has that advantage of developing a huge amount of money. Public issues most popular of raising capital by these entrepreneurs. Yeah, the entrepreneurs as in successful entrepreneurs who has a lot of business, and the public issue is considerably larger than any kind of investment, any other kind of investment such as venture capitaling and private placement. Access to capital, the primary advantage of the enterprise has to gain by going public is the access to capital. We learned about that. The access to both domestic and foreign capital. Capital does not have to be repaid. When you're taking money from a private investor, the private investor as in when your company is a private company and you're only asking investment from 200 people, it's called they are called private investors, and private investor might want to take his money back. In such occasion, you have to literally collect all the resources that you have and then repay the money back. But if he is asking it in the wrong time, like when your business is already in trouble, and if your business is already having very less cash flow, and he has to take his investment back. In such time, it will be very difficult for the business and the management to acquire and spend that kind of money to payment of investors. So any company would not want to roll their heads over this kind of problem. So to avoid this from happening, there is public issue. So in public issue, there are like thousands of people who are ready to invest in a company at any time. Therefore, if one company faces an issue of investor taking his money from the company, any other investor will be willing to invest in that company at the precise time, at the same time, or within 1 or 2 days notice. Therefore, if a company has like 1 lakh investors, each investing 10,000 rupees, 10,000 rupees, that is about 100 crore. Therefore, if one person, just one person or two person wants to take his money back, there will be other people who are willing to invest in the company. They will be just waiting to find a slot. That's all. So therefore, you do not have, the company is not liable to repay the investors at that point. And it does not involve any interest charge also, because it's not a loan, it's just a sale of share. If you have bought loan from the bank, then you need to pay interest for that, but it's just a sale of share. Therefore, there is no interest payment. The only reward for the IPO investors to seek appreciation. That means that you would have heard in the market that the share value of some company has gone up, share value of some company has gone down. It means that when investors are buying the shares of a company, they buy it for particular amount, which is called the face value. But it rarely happens that the investors are buying for face value, because 99.99% of the time, unless you are buying the shares of the company the moment it was released, you will be purchasing the shares of a company for a higher amount than the face value of the shares. You know what face value means? Face value is the original value designated for a share. It is the original share price when the share was released. But after it was released, the value will go up, and more people will be demanding to buy the shares. Therefore, it increases the price of the share also. So if a face value of a share is 10 rupees now, a 10-year or 20-year-old company will have the share value of about 1,000 rupees also. So that 990 rupees is the appreciation in the share value. Therefore, like I said, in IRCTC IPO, the original, the share value appreciation is about 600% than the value of the face value of share, which means that, for example, if the IRCTC has issued the shares for 10 rupees at the beginning, in one day the 10 rupees has gone to 60 rupees. Therefore, anyone who has invested 10 rupees in the IRCTC will gain 60 rupees. That's called the share appreciation, and that is the profit for the investors. The share appreciation happens only because of the demand, not because the company is paying them money, 6 times the money or anything. And the second kind of profit for the investors is dividends. Dividends is kind of like a loan, but it's not compulsory. The company can pay dividend when they want, or if they can choose not to pay dividends also. Dividends, like I said, dividends is just like a loan. It is calculated on a percentage of shares. Like if the share is 10 rupees, now company can pay 1 rupee per share, which is 10% dividend. Therefore, dividend is not mandatory to be paid to the investors. Only when the company sees that it is okay, the company has a lot of money to spend to pay the investors, they can pay the investors. And entrepreneurs can raise this kind of capital for various reasons. One is growth and expansion of business. They can build new plants, expand it into new places and everything, and retiring existing debt. If the company has a lot of debt and if it is paying a lot of interest, to avoid that from happening, the money that is raised from the public issue can be used to close the debt that is bought from various people. And the third thing is corporate marketing and development. It is like I said, going public will increase the brand awareness of your company. Therefore, along with that, some other marketing strategy should also be followed to make sure that your company's products are being well heard everywhere.